For Your Money is brought to you by NelsonCorp Wealth Management.
It's now time for Your Money. We're joined by John Nelson, financial advisor at NelsonCorp Wealth Management. Welcome back, John.
Thank you for having me, Brandy.
So most bonds and financial assets that are sensitive to rising interest rates have had a rough year in 2021. What can you share about what's been going on in the bond market and the things that you're watching?
Yes, safe bonds like treasuries they're still showing negative performance numbers for this year, even though a lot of that damage actually came at the end of March earlier this year, and it's kind of been a slow tick, a recovery for them. Volatile ride nonetheless, but a little bit of a recovery since then. We've seen things pick up. I've got a graphic here with me that illustrates the 10-year minus the 2-year Treasury yield curve. This is one of the most widely viewed type yield curves, even though there are many of them. And what this is showing is it's just illustrating, the volatility that we've seen and actually a falling or a flattening yield all the way to the right there that I have circled, which is not typical. We've seen it in the past where the yield curve has inverted, it's gone below zero. But this is a flattening a little bit quicker than you normally see. Sometimes an inverted yield curve is a precursor to a recession, followed by inflation picking up, spending, which we've seen play out very typical to other cycles through 2020 and 2021. But now we're seeing a little bit of some softening, a flattening the yield curve, and implications for that. Maybe a little bit of a warning sign for the economic recovery.
All right, so tell us, what other implications are there for a flattening yield curve?
Yeah, a couple other areas that of focus, mainly the big one would be financial sector. Think of banking. Banks take in deposits, they then pay short-term interest to those depositors. They in turn reinvest by making long-term loans where they're paid long-term rates. So they really benefit from a low short-term rates and higher long-term rate environment. The flip side of that would be, real estate or certain sectors of the real estate market where many of those transactions are done with long-term interest rates. So if we're seeing a flattening cycle, again, these are very early signs, but if we are seeing a flattening of the yield curve, there are certain sectors or certain parts of the market that investors should be well aware of their investments going into that type of environment.
All right, John, thanks for taking the time to talk with us today.
Thank you for having me, Brandy.
If you missed any of our discussion, we'll make it available for you on ourquadcities.com.